The S&P 500 closing in on 5,000. For more, let's bring in Ed Yardeni of Yardeni Research. Ed, it's so good to talk to you. Your thoughts as we close in on history.
Well, yeah, I mean, happy days are here again, as they said in the 1920s. This is the 2020s, and my roaring 2020 scenario is almost on steroids here. I've been last year I was talking about 4,600. By the end of last year, we got there by July. This year I've been talking about 5,400, and here by the end of this year, and we're already at 5,000. So it's been phenomenal.
Yeah, I mean, it didn't end very well when you talk about the 1920s, did it?
No, but
there are some who are suggesting that it's. I'm sorry, there are some who suggest I'm sorry to talk over you, Ed.
Okay, go ahead.
I was just going to say there are some who are suggesting that we're repeating one of these type periods here, that there's just too much euphoria, thinking that it's just going to go on forever in a very small number of names.
Well, I agree with what Aaron and Josh were pointing out. I would add that the productivity numbers have been awesome. I've been expecting the productivity growth boom this decade, and I think it's already started. It started last year. We had much better than expected productivity numbers during the last 3 quarters of last year. Productivity is up 2.7%, and that's like fairy dust. Productivity allows the economy to grow faster, it keeps inflation down, it allows wages to rise faster than prices, and it's great for profit margins and profits.
But you're the one who used the word euphoria in recent notes, not necessarily suggesting that it was here today, but that the early signs of it were starting to be present. Can you explain?
Well, it's really more exuberance, and the question is it rational or irrational? I was saying that the alternatives to the roaring 2020s is something like the 1990s, where we get irrational exuberance and things move too quickly. And there are similarities in what we're seeing here in terms of the concentration in tech. But remember, back in the late 1990s, a lot of tech really didn't have earnings. And not only that, but a lot of tech was rigging their sales with seller financing. It's particularly in the telecommunications area. This time around, the earnings are real. These companies that are doing well don't depend very much on debt, and they've got what it takes to deliver for investors.
Hey, Ed, it's Josh. Good to see you. I was going to say there are a lot of signs that we're not at euphoria, at least not yet. For starters, Americans put $1 trillion into money market funds last year.
Correct.
Most of that, if not none of that, has come out yet. That's not euphoria. How many IPOs did we have last year? 4?
Yeah,
7? I feel like I can count them. That's not quite euphoria. No IPOs this year yet either, worth speaking of. Those are 2 of the things just off the top of my head that you would say would be very inconsistent with this idea that it's 1999. And to your point, I was around, Michael Santoli was around. We saw the types of deals that were coming out.
Right.
Forget about earnings. They didn't have revenues. They were worse than the 2021 SPAC vintage. So this is not that. We might get there if this keeps up. We haven't gotten there yet.
I think it's rational exuberance so far. I think it's justified by the performance of the economy. And by the way, on a global basis, we really stand out. China's in a recession. Europe is in a recession. The world isn't looking too good. Meanwhile, we're doing remarkably well. Inflation's come down without a recession here because China's had the recession. So all in all, the U.S. is benefiting from a lot of the developments on a global basis. And even though the geopolitical situation is just downright awful, we haven't seen its impact so far on the price of oil. If we suddenly see the price of oil going up, ask me to come on again, and I'll be concerned about the 1970s all over again.
What if we're doing too well, though, and that prohibits the Fed from cutting rates when the market wants, because you've got the labor market still too strong and GDP prints that are going to shock people?
Well, I have no problem at all with the unemployment rate remaining below 4%. I know some Fed officials previously said that they'd like to see the unemployment rate above 4% in order to bring inflation down. But much to their surprise, not to mine, quite honestly, we've been able to see inflation coming down without unemployment going up. And that's because productivity is making a comeback. Look, I have not been in the camp that has been rooting for or expecting that the Fed's going to give us 5, 6, 7 rate cuts this year, because I've not been in the recession camp. I have been in the disinflation camp, but I think interest rates have normalized. They're back to where they should be. I don't really think we need to cut rates. The economy's doing just fine.